Hey everyone, welcome back to Corporate Decoder, the place where we pull back the curtain on big business. We've got a real doozy today, a report that is essentially a giant financial buffet for a massive energy project. Today we're diving into NextDecade Corporation's latest filing. And let me tell you, it is a story about big money, big projects, and even bigger decisions. Think of it as the ultimate financial wedding registry for building a giant natural gas export facility. Alright, so let S jump right in. The big news here is that NextDecade Corporation has made a final investment decision, or FID, for its Train 5 project. You can think of this as the official green light for construction on the 5th natural gas liquefaction train at their Rio Grande facility. This isn't just a small handshake deal. It is a complex web of financing agreements that underpins the entire project. First up, we have the T5 Common Terms Agreement. This is like the set of rules for everyone involved in financing this train. 5 project, it lays out common promises and expectations for the company, and what happens if things go wrong. It also sets the stage for how they can borrow more money later for things like covering daily costs, refinancing existing debt, or even for expansion. Then there is the T5 Collateral and Intercreditor Agreement. This is where things get serious about who gets paid first if something goes south. It details the agreements among the different groups of lenders and how their claims on the project S assets will be handled. Imagine it as a pecking order for the money people. To back all this up, the company has put up collateral. They've pledged ownership stakes in the project companies. This is pretty standard stuff when you're borrowing billions of dollars. They're essentially saying if we can't pay you back here as a piece of the project you can take. The T5 Accounts Agreement is all about managing the money flowing in and out. Before construction is done, it ensures money goes into a special construction account. After the project is up and running, it lays out a system for how all the project S earnings will be used to pay off debts, and eventually, hopefully, make profits. Now, let's talk about the T5 Credit Agreement. This is a major loan agreement for up to $3.589 billion. This money is specifically for building the Train 5 project. The loans will be paid back over time starting after the project is complete, with interest rates that can change based on how well the project is doing and what credit rating agencies like Moody, S&S, and P say about it. Importantly, this agreement includes strict rules about how much debt the company can take, on how they can spend money, and when they can pay out dividends. There are also conditions that could trigger a requirement to pay back the loan early if certain things go wrong. Alongside the T5 credit agreement, there is the T5 indenture, which governs $500 million in senior secured notes. These notes are a different type of debt, but they also rank high in terms of priority for getting paid back assuming the project. S collateral is involved. The notes are being sold privately and aren't T-registered for public sale, which is common for these large project financings. They mature 20 years after they start being paid back, which is a long way off in 2050. The interest rate is fixed at 6.56%, which is a pretty significant commitment. The company also has options to pay these notes back early under certain conditions. Moving on to the Finco and Super Finco facilities. These are essentially financing vehicles that will provide equity contributions to the project companies. The Finco credit agreement is a substantial credit facility up to $1.463 billion. This facility is crucial for funding the equity portions of the Train 4 and Train 5 projects. It also has a large sublimit for letters of credit, which are like guarantees that can be used to back up the company's commitment to invest in the project. The availability of this facility depends on regulatory approvals, which is a common hurdle in this industry. It matures 5 years after the FID date, with an option to extend. Interest rates are set at SOFR plus a margin or a base rate plus a margin. And like the T5 credit agreement, there are rules about hedging interest rates and restrictions on debt and dividends. Then we have the Super Finco credit agreement. This agreement is being amended to add $600 million for a Series B loan, which will be combined with an existing Series A loan to form a $1.2 billion facility. This money also fuels equity contributions for the Train 5 project. The interest rate here is a hefty 13% fixed, which is quite high, reflecting the risk involved. Interestingly, they have the option to pay some of this interest in kind, meaning they can add it to the loan balance instead of paying cash. This shows a strong focus on preserving liquidity. This facility also has detailed prepayment and other restrictive covenants, similar to the other agreements. In a more forward-looking move, there is a term sheet to amend the corporate credit agreement. This indicates they are looking to make some significant changes to an existing credit line. They were planning to add a $100 million exchangeable loan, which means some of the debt can be converted into company stock under specific conditions. They were also increasing the interest rate on the existing corporate credit agreement to 13.5% and expanding the collateral. This suggests a willingness to restructure existing corporate debt to support the massive project financing. The company anticipates closing these changes later this year provided all the paperwork gets finalized. The Train 5 joint venture agreement is key to understanding how the ownership of this massive project will be shared. NextDecade's own contribution as the ND member will be 50% of the equity in the Train 5 joint venture company, with the potential to increase to 70% if their financial partner meets certain investment return targets. This structure shows a partnership where NextDecade is a major player but not the sole owner. They've committed to a significant portion of the equity financing, totaling about $1.285 billion for the Train 4 project alone, and will be using funds from these new credit facilities and cash on hand to meet their obligations. Now, for the ultimate conclusion, the board of directors has officially approved the final investment decision for Train 5, and they've given Bechtel the green light to start construction under their engineering procurement and construction contract. The estimated total project cost is a staggering $6.66 billion. They expect the project to be up and running in the first half of 2031. That is quite a timeline and a massive undertaking. Looking at this filing, it is clear NextDecade is making a huge bet on the future of LNG exports with its Train 5 project. The sheer amount of debt being raised, over $5 billion just for this portion of the project, is immense. This strategy leverages significant debt to fuel growth, which can magnify returns if the project is successful, but also amplifies risk if it falters. The complexity of these financing agreements highlights the intricate nature of large infrastructure projects and the careful balancing act between attracting capital and managing obligations. The company's direction is aggressive, focused on expanding its LNG export capacity. The strength lies in securing such substantial financing and a final investment decision for Train 5, indicating confidence from lenders and partners. However, the primary risk is the inherent volatility in global energy markets and the long construction timelines, which can be subject to unexpected costs and delays. The high fixed interest rates on some of the debt, like the 13% on the Superfinco facility, also represent a significant ongoing cost burden. In conclusion, NextDecade is pushing ahead with an ambitious expansion. They've successfully navigated the complex financial landscape to get Train 5 off the ground. The success of this project will hinge on global demand for LNG efficient execution of construction, and NextDecade's ability to manage its considerable debt obligations through the years. It is a high-stakes play in the energy sector. Alright, that is our deep dive into NextDecade's latest filing. What are your thoughts on this massive investment and its potential impact? Let us know in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more corporate breakdowns. And don't forget to join our Discord community, linked in the description. Thanks for watching. See you next time.